Powell testified before Congress today, throwing a wet blanket on the market. We should look at what levels the S&P 500 held and which ones it could test should we go further. We saw a lot of strange events. When Powell spoke, we saw them actually go out and buy bonds. So as equity sold off, they rotated and bought the 10-year. At the same time, the 2-year spiked over 5%, and this inverted the yield curve even more. Why the inverted yield curve is actually bullish for equities. Following up on what's going on during the last hour of trading and how that's correlating to what's going on in the index. One investor who already thinks we are in a recession. Why tomorrow's JOLT report could be setting up one large bear trap. 5 names that we need to cover, one including Crowd, which absolutely crushed earnings and raised expectations. Powell testified before Congress at 10 a.m. today, alluded to the fact that we might have to raise interest rates more than expected. Now, there are 2 major issues. Number 1, this was not expected. Number 2, the Fed is not in the habit of saying one thing and then doing another this fast. In other words, it was literally weeks ago that we were talking about 25 basis points. And we're seeing comments like this come out of investment banks. Whether the FOMC hikes 25 basis points or 50 basis points, we expect that the medium dot will rise by 50 basis points at the March meeting to show 5.5 to 5.75. We have raised our own forecast by 25 basis points. So in other words, Goldman Sachs is coming out and saying, based upon what he said today, we're setting up for higher rates. And you can see the frustration in investment banks. UBS's comments, the question Fed Chair Powell needs to be asked is, what do you think you're doing? Powell has yet to explain how rising rates will tackle profit-led inflation. Pursuing higher unemployment seems an ineffective response. So you're starting to lose the banks here. Here's the hourly chart, and you can just see the reaction, 9:30, 10 from Friday, how we just rallied up. This is obviously a moving average based upon the 200, just so you can understand what you're looking at here. This is the 200. So in this chart, it's the 200 simple moving average of the hourly. So we got up here, right? Same level as this, and then just kind of rejected as the day went on, kind of trickled down. Now you're into Tuesday. And then it was just a mess after he started speaking. And the reason is because it's very rare that you say one thing as emphatically as he did and then change it because you have a couple data points. That's usually not what Fed chairmen do. And I know that most people that are trading right now have only had Powell, but this is not how this is supposed to go. You're supposed to set a course and then you're supposed to be able to act based upon the course being set. Can things change? Of course, but they're not supposed to change weekly. And that's the issue that we're running into. Now, what is this doing to the market? Well, it's making the market come back down, right? They're becoming uncertain. If we see what's happening, all I see is us filling gaps. I'm not saying we can't go lower. Certainly the market was priced for 25 basis points. And we can see how we have given back everything from Friday already, completely given back. And not only do we give back the gains, but you just see people that are just completely out of position now. And I'm going to explain that in a moment. But the question is, what do we do now? Well, we have one more day of testifying. That is tomorrow. After that, we're on our own. But during that, we have a lot of economic data that's going to come out. So if we look at this on the 15-minute chart, what exactly is happening? All we did was come right down to this core level and hold right on Thursday. And now we're bouncing right here. Now, are we going to hold here? I don't know. If we break this level, there's very little in here until we get to about 39.40. So that's going to be our core level to watch. And that correlates perfectly with the 200-day moving average. Now, the purple is a 55 simple moving average. I tend to use a 55 more than a 50. You can see how we stopped right on there. Now, usually when you have a golden cross, which is right here, and a golden cross is very simply in my situations when the 55 crosses the 200 to the upsides, the more standard is just using a 50. So here you have your cross, right? Once this happens, this is supposed to stay support, this being the 200-day moving average, not the 55. So it's quite possible that we break this again and then have another test. Do we go lower? Well, that's going to be dependent on the economic data that's going to come out that we're about to go over. But it's been working quite well. Here's our death cross, and then it took that point of resistance. So here it's taking the place of support. It's going to be support until it isn't. It's really that simple. So we're going to have to watch how this plays out. But there were a lot of really strange things that happened today. The most levered stocks out there are technology names, not only just Apple and Microsoft, but tech in general. Now, here we are with the XLK, which is the technology part of the S&P. If we take a look at this, we can see very clearly that this is Friday. And here's where we're at. So we still have gains from last Friday. The S&P itself eradicated all those gains. This is healthcare. So they are dumping healthcare. They are dumping defensive names more than they are dumping technology right now. That's not how this works. In other words, if they wanted to be defensive, they would be buying healthcare. They would be buying the defensive names. Instead, we have the healthcare sector down 1.6%. We have utilities down 1.6%. And then we have tech down 1.2%. It doesn't make any sense. If you were going to be defensive and you were going to be getting out of tech names, this should be down way more than it is. This should be leading the charge down, and it's not. Am I happy with today's action as someone that wants to be long and stay long this market? I am from the standpoint if you're going to take a long-term view. If you're going to be trading this right now, this is going to be very difficult to trade until it sorts itself out. You're going to get a much better read by Wednesday on Friday on what exactly is going here. Goldman has a very strong opinion on this. Morgan came out with a statement as well. We're going to get into that in a couple minutes here, but I need to watch these levels, and you can just mark them off right here and just take a look at it in regards to the SPY. You're right here at 397 on the 55. You're right here, right around that 391 level on the 200. You do not want to break either one of these. If you break this 200, all bets are off. It's been a long time since I've seen us break a 200 after a golden cross. The last one that I could find going back after golden crosses was 2019. So it's been a little bit like 4 years before we see anything like this, where you've broken a golden cross. And even then, all we did was come down to it and then just hold it, which is exactly what's supposed to happen when you have these crosses here. This is supposed to become a major support level, and that's exactly what happened. Here we are in 2016 golden cross, and then you can see back here, this held as well. It does not mean it's going to hold this time. All we have is what has taken place in the past, and then we can use that going forward. There is no guarantee that it holds in here, but what it means is that this area is pretty significant, and we need to watch that, and we want that to hold. If I saw more tech selling today, like massive amounts of tech selling, but that's not what I saw. I saw them buying the leaders. We're going to go over a couple of those, and then just run through your own numbers. Take a look at the NASDAQ. The NASDAQ held support right in here, didn't get below. These are not signs of massive selling. IWM, which is the Russell 2000, that held. Now, this does not look great. I'm not thrilled about this, obviously. You can see the movement right here, and you see your line, and you're sitting right on here for the third time. That's not ideal. But even this outperformed the S&P. That's not what happens if we're going to correct. Here we are in the 10-year, and you can see how we just kind of bonked around in here. This is from the ISM number that was significantly higher than expected. Anything over 55 is high, and that was high, and all they did was buy bonds. And just to be clear, they're still not above that level. If we drill into the bond market, we can see very clearly when Powell started to speak, when his prepared remarks were released, and then he started to speak. And ever since then, they just were buying the 10-year. Now at the 2-year over 5% and the 10-year hovering around 4%, that gives us an inverted yield curve of about 100 basis points. You can see the 100 basis point line right over here. And you can see how many times we've actually been here in the past 40 years. And we've only been down to this level once. Now, why am I showing you this and what's so significant about this? Well, everyone is looking at this and saying this is really bad. Can this get worse? Absolutely. Last time we were at 200 basis points. So you're not even halfway there. That would give us a 4% 10-year and a 6% 2-year. But it's becoming increasingly clear that this is a massive outlier, that in the worst case scenario that we have on record in the past 40 years is another 100 basis points. Is someone going to stop buying bonds because the 2 year is going to go from 5 to 6%? I don't think so. I don't think someone who wants to buy the 5% 2 year is not going to buy it because 2 years from now they want to make sure they get 6. They might leg into bonds here, which is probably what most investment banks are telling their clientele to do that want bonds. So here we are, and we can see down here in 1980, and then we bounce back up, and then we come right back down, probably around 81, 82. And we're being told about how this is going to drive us into a recession. I have news. We're probably already in one, which is what they like to do. They like to wait till we're in it, and then they announce it 6 months later when it started. Here's when you had 200 basis points of an inverted yield curve. Rallies up, comes back down, comes here. This is when you retest that level on the yield curve. You never took out a new low. And then from this level, we went on an absolute tear. Let's go to the top of before the crash. So you had 180% move in the S&P over 5 years. Now, the importance of this, here you are with high yield. Companies that want to issue bonds are going to issue bonds towards the tail end of when the Fed is done. So they're watching the Fed, they're waiting for it to be done. Now, them being the Fed, stating that they are going to kick the can down the line, our time frame may have gotten extended by his statement today. We're going to find out more, and we're going to want to pay attention to these numbers that are going to come out starting tomorrow, and we're going to go over them next. But if high yield starts to rally and the appetite for high yield starts to get stronger, then companies are going to go into the bond market, they're going to issue bonds, they're going to take that money and they're going to expand, or they're going to buy stock back. Either way, two things are going to happen. Revenues are going to increase and earnings are going to increase based upon them borrowing in the market to start trying to get more leverage off of the bonds. Very common, happens all the time when you start to turn. In other words, when they know that rates are going to come down, that's when they start actually getting involved, because they start realizing, well, wow, these are some of the best terms that we're going to get. As it starts to drop, they start taking advantage of it. Now, I don't see the bond market breaking here. I don't see any signs that the high yield market is falling apart anymore. Now, technically speaking, am I crazy about the way NVIDIA looks here? No. Did they just do a shelf offering where they said we're going to issue stock, preferred stock, bonds? And did the stock do anything? Yeah, it came down and almost filled the gap before rallying and then hitting new highs, and then rallying again before tomorrow's economic data. So we're not exactly seeing these companies that are issuing debt fall off a cliff, are we? Now, one of the graphs I've been asked to follow up on from your comments below, and please comment on this video. Your comments help me drive what I'm going to go over. Now, if we take a look at this, this is the last hour of trading. And what they do is they assign a value to the last hour +1, and then every single time it's +1 or -1, this line moves. Now, we're looking at 10 years. Let's drop it to 5. And then we can see our level right here and how the market came in when this was bottoming, and then how the market starts to turn as this starts to turn. Well, the reason that the last hour is important is because that's institutional buying in general. Go out to 3 years, it becomes even more pronounced, where we can see the breakout of the last hour, and we can see right here pretty clearly in November how that was pretty much the low, and now since then we've just been grinding higher. So consistently we're seeing buying in the last hour of the day, and the S&P is still just standing stagnant. The question is, how long can the last hour continue to go up and the market stay stagnant? I don't think very long. One of these two is going to have to give. Now, which one that is, I don't know, but there should not be an inversion here. In other words, if institutions are truly selling, as quote, smart money shows that they are, who's buying in the last hour? Right? Who's able to buy in the last hour and move the market? It's certainly not retail. Zooming in on this in 3 months, where are we? What's been going on? Every single day, we're adding a 1 to the end of the day and moving higher. So in other words, while the market might not be at that high that it just was, okay, but at that time we were sitting right here, right at that 541 level, and now we're back up here to a 543. So are institutions buying, considering that institutions buy in the last hour? So are institutions buying since the high, or are they selling? So my opinion is that they are buying, because no one else is going to be able to do this to the market. Retail cannot move the market the way that institutions can. Now, that doesn't mean that they're going to be right. That doesn't mean that you're going to go straight up. That's not what I'm saying. We can obviously come down tomorrow dependent upon what the economic data is. I'm not talking about a day. I'm talking about months when we're looking at some of this data. But let's dive into what's going to happen tomorrow and how we can benefit from it. Now, tomorrow we're expecting the JOLTS job openings to come out. This shows the amount of jobs that corporations have outstanding. And I just want to go through these so we get it. Here's the actual number last time, 11 million versus 10.25. The forecast is now 10.5. What's interesting about this is about a couple days ago, it was actually 10.6. So they've already dropped this number. You remember back in October how this number actually rallied the market, and then we sold off back in November when it came in higher than anticipated. This is a very widely regarded number about what's going on and gives us some indication going into non-farm payrolls on Friday. Now, Goldman Sachs has issued a statement to its investors that they are expecting rates. Now, Goldman Sachs issued a statement to its investors that it is expecting the jobs number to come in significantly lower than expected, to the tune of about 400,000 to 500,000. That's a really gutsy call ahead of this number. Now, how they're getting there, one of the things that they're using is the warn notices, and that they say that these warn notices suggest layoffs have risen a bit above the pre-pandemic seasonal norm in the last few months. And what they're doing is they're showing you the level that they feel that you're going to be out. And I think it's somewhat interesting. Now, if you look at this average, which is in light, which is 2017, 2019, and then this shows where we are from 22 to 23, what they're saying is based upon their observation that we're up here. Well, that is substantially higher than we're anticipating. What they're saying, based upon their warn notices and their tracking, they're seeing a layoff rate of 1.1% versus the current rate of 0.9%. Why it does not sound like a lot, it is on a percentage basis. And both of these layoffs are still lower than 2019, we should note. But what does this tell us? Well, this tells us that if you follow their line and where they're tracking and saying where we're going to wind up, they're saying based upon the warn notices and the layoff rate that these are out of alignment. And this layoff rate is how you calculate the job openings. Therefore, the number is going to come in lower. They're saying 400 to 500,000. Now, we'll touch base on this in the next video, but Bank of America, not to be outdone, is already coming in and saying non-farm payrolls on Fridays are going to come down substantially lower than anticipated. So the question is going to be, what is this going to do to the market tomorrow? In other words, everyone here is expecting a hot jobs market. They're expecting the market to drop based upon more of Powell's speech, which it very well could. And then what's going to happen at 10 o'clock when this number is released? If this number comes in line with where Goldman Sachs is, you're going to have everybody out of position again, once again. Okay. And this, very candidly, this is how bottoms are formed. Okay. People don't believe that the bottom's in, and they keep waiting for the next break of news, and then the news keeps getting worse. I have no idea what this number is going to be, but it's definitely something that we're going to want to watch tomorrow very closely. And if you see a number that's lower than expected, most likely equities are going higher. Now, in front of us is the LEI year over year. And this one investor came out today and was very clear about it. His opinion of the market, and he runs Double Line, Gundlach is his name, worth listening to, worth paying attention to. And he's got a point here. So in other words, what he's looking at is LEI, and LEI is leading economic indicators leading up to recessions. And he's going from 1968 to 2020. What we see with LEIs as we're coming straight across and down is this blue cloud. We're obviously through that blue cloud, and we're obviously through the zero line. But why he's saying we're probably 2 to 3 months already in a recession is you can see right here where LEI is, and LEI is out of the cloud and not aligned. So now if we're out of the cloud and we're not aligned, if you move over, that would get you to the average, which would be about 2 to 3 months of us being actually in a recession. Candidly, whether or not we are, that's usually how it goes. By the time that they announce a recession, it's usually over. Every bear market that has ended has not ended until we are out of a recession, or at a minimum until it has begun. And that is definitely something that I'm watching as well. But I'm not going to not trade because I'm waiting for something like that. So that's just not really how I trade. But it's definitely something that we should be aware of. Crowd beat revenues by 2% and earnings by 10%. They also raise guidance. Now, this is not usually what you see if we're going into a recession. And then what we're hearing is, oh, the recession is going to be next quarter. So why would they be raising guidance? And why wouldn't they just being conservative? That's the question I have with a lot of these companies that are raising guidance. If they thought that that's what the situation they're going to be in, why are they raising guidance? And we're going to get into 2 other companies today that did the same exact thing, that both charts look amazing. Now, if you take a look at what's going on here, we're just in this trading range, in this gap. Watch the 137.98 level tomorrow. Let's call it 138 just to make the math simple. You want to watch the gap fill and see how we act there. You can see we're already above the 55 and curling up, and we're into this range right here. Needham put a strong buy on this ahead of the quarter, and I'm sure they're going to come out and defend it tomorrow or talk about it, about how smart they are. And I would expect to see more of that tomorrow. Airbnb was at the Morgan Stanley Technology Conference, which is going on until Thursday. And what I like about this is we've come back, we've gap filled, then we tried to rally, pulled back, but we didn't break the open, did we? We didn't break the doji either. This makes this trade really simple to watch if we're going to sit on this level and if we're going to hold in here or not. And what we're seeing is we're seeing a ton of this. We're seeing these breakouts, and then we're seeing the gap fills, and then we're seeing them build and go higher. You're not seeing the majority of them. You are seeing some of them, but you're not seeing the majority of them break and go down. And that's exactly what we want to look for. We want to look for companies that have beaten expectations, beaten revenue, and are raising guidance. SE is one that they were trading in the room today, and you can see that they just absolutely crushed off the open. Look at the revenues, beating by 13%. Surprise to the upside, 300%. I believe there's a charge in here or some kind of write-off that exacerbated that. And they actually said it was 79 cents, but it was still like just an insane beat. Raising guidance. Look at the volume that's coming in. Okay, that is not retail. That is just deciding that they need to be in here. Doesn't mean we're going straight up, guys. I want to be real clear about that, right? You're going to bounce around, but these kinds of names need to start being on your radar. Names that are getting above the 55, that are getting above the 22. These are names that you want to start putting on the radar, okay? And you want to start watching. You want to look for names like this that are beating expectation and raising estimates. And you can see these bases. And we're breaking out of these bases. We're above the 200, the 55, and the 20. Why are we 22? Now, why we sit here and talk about econ data, and I can do that all day long, you need to trade what's in front of you. Here's another just absolutely monster trade today. You can see Dick's earnings came out. They beat, exceeded expectations, and they raised guidance. If we were going into a recession and going to have a hard landing, why would they be raising guidance? It's very possible that all these people are wrong, and all these corporations and the people that are doing all this forecasting are wrong. But we've seen them really rein it in and do a lot of kitchen sink quarters where things are going to be bad even though they're not, and they're not doing that anymore. What we're seeing is stocks breaking out through all-time highs. This is really hard to miss, guys. I mean, this is, you're breaking out of a 3 calendar year base here. Okay, so it's not like there's not names that are breaking out and pushing forward. The question is, are we going to continue to have follow through, or are we going to see more damage based upon what's going on with Powell? So tonight's video is a little bit longer. Watch these key levels that I have marked on the chart. That's what you're going to want to watch tomorrow. If you like the longer format, please comment that you like the longer format and what I could add to it. I do read all your comments and I do respond to them. So I do find the comments extremely helpful. If you find value in this, please share the video. My goal with this channel is relatively simple. It's to put out actionable information that people can utilize to make better decisions. It's that simple. So if you find value in it, share it. And if we didn't do a good job, or if I didn't do a good job, then don't share it. Have a good night, everybody.